Hi, this is James Aim with Full Capital, and wanted to come to you today with impact of coronavirus on multifamily version number 2. So a lot has happened in the last couple of weeks, and just wanted to give you guys a little bit of an update and really talk about the three questions that I'm getting a lot today. Number one, should I be buying? Number two, should I be selling? Or number three, should I be refinancing? So just a little bit about my background. Born and raised here in Houston, finance degree out of UT Austin, lived in DFW since 2006. Was an underwriter for G Capital for 10 years, underwriting over $750 million in commercial properties. And since then, the last 5 years have been really focused on multifamily and done over $750 million across 125 properties across the US, and then also invested in about 21 properties, 6,000 units across DFW, Austin, and San Antonio. So the first question I'm getting right now is, should I be buying? Is this the right time? So let's go through some positives. Lower interest rates, 3.5% to 4% right now, compared to majority of the loans that I've done in the last 4 or 5 years have been 4.5% to 5%, maybe 5.25. So you're getting about 75 basis points to 100 basis points lower on interest rate, which is corresponding leading to higher leverage, right? So Fannie Mae, Freddie Mac really look at debt service coverage is usually the constraint. So most loans are about 75 to 80% right now. There's less competition. I mean, the last week I've gotten 4 or 5 emails from general partners saying, we're not going to do anything. We're going to close the deals that we have under contract, but we're not going to look at anything new. So there's going to be less competition in this market. So there might be some deals that come up where sellers want to sell and capture their gain. So there's going to be less competition. And then potentially with less competition, there's going to be lower earnest money requirements, less non-refundable, and then longer timelines for closing and extensions. Some of the negatives, here in Frisco, here in Dallas-Fort Worth, there's been a lot of closings, shutdowns just from the coronavirus. So this contraction in business, the next couple of months, there's going to be layoffs, not necessarily permanent layoffs, but then short-term layoffs. And so if tenants are unable to pay their rent, delinquencies, vacancies are going to go up as people are going to start doubling up, or potentially worse, staying in their unit but not paying. Number two is rents and occupancy could be dropping in the short term. So where you might have thought, all right, I'm going to come in, rehab the unit, raise rents $100, $150, that might not work right now. So people are going to probably be sticking around in their unit, renewing that current lease. And this could impact your ability, sort of pro forma year one, potentially year two on your rental income. And number three is the volatility in the equity market. So even if people are not in the equity markets, a relatively small amount of money, let's say 10% of their net worth is in equities, those equities are worth 25, 30% less right now, just with the market down so much in the last 2 weeks. And so that might impact your ability to raise equity. And so getting a temperature of your investors would be a good idea. And so if you do move forward with buying, some of the things that you could be doing when you're going through the process, whether it's bidding, best and final, and here are a couple of considerations. Number one is, we've been looking at deals and it's been 1%, 2% earnest money. That's non-refundable day one. Maybe limit some of your earnest money. Number two, increase your due diligence period. Things we took for granted, like walk-in units, that is taking longer. Tenants are having to step out of their units. People are having to go in with, different safeguards. And then even engineers and environmental people and appraisers who are flying in, they can't fly in. So due diligence periods are going to be longer. Your initial closing timelines typically is 60 days, but it might be 75 days now. Having built-in extension periods, so whether it's taking longer for the loan or longer for you to raise equity, I think those built-in extension periods are going to help a lot. And then as a general partner, additional liquidity. So if you need to go out and raise that additional 400,000 to 500,000 and you just can't get there, but you need to close your deal. Having that additional liquidity is key. And then also thinking about lower leverage. A lot of times when things go bad and things go um, sideways in a market, rents dropping, occupancy dropping, you wish you had lower leverage. It just gives you more flexibility. And even though your returns are lower, you're still talking about positive returns versus giving back all or giving none of your equity back if there is a foreclosure on a loan. Raising additional capital to weather any short-term rent and occupancy decreases. I think this one's huge. Most people are saving maybe a month or setting aside maybe a month of working capital, a month of debt service, month of expenses, but it probably needs to be double or triple that, especially if rents and occupancy starts decreasing. And then before you go out and put your hard money down, put a deal under contract, I think it'd be good to get a gauge on your investor base. And, whether it's just a short sort of multiple choice questionnaire or something like that, where maybe I should put out, if you had three options right now, number one, 50 invest 50,000 or more in this deal, unsure, or I'm not investing right now based on these parameters. Maybe you just give them some high level of your deal and just take the temperature of your investors, right? Because if you're going to have to go out and raise, 3, 4, $5 million, and you're doing it 50 to 100,000 a piece, you're going to need people to commit to a deal. And understanding their temperature right now is key. And then the last thing is run your downside scenarios. Showing investors, look, if the occupancy is 95 right now, if it drops to 85, what does it do to my rental income, my expenses, my debt service coverage? If rents drop 10%, how do you cover? And what are the considerations on that? Okay, so now on the flip side, should I be selling now? So there's been a lot of deals on the market, and the question now is now the right time to sell. So positives, you can lock in your value appreciation from your increase in rents that you've had the last couple of years, and also helps your track record in the future. And that's sort of locked in, right? Once you sell, you can point to, all right, I bought it for $5 million. I raised the rents. I sold it for 7 million, and that is locked in, right? So number one, that's positive. Number two is when you do sell, you're going to have more cash reserves. And so if this is sort of a black swan event and coronavirus ends up being a lot longer negative on the economy, then you're going to have more cash reserves for buying deals later in this downward cycle, if it is a downturn. And then rents and occupancies might decrease this year. So if there are layoffs, which lead to less tenants having jobs, which lead to less potential tenants for your properties, that's going to decrease your cash flow. And decrease cash flow, and you're not going to be able to sell the property for as much. So those are the three positives. On the negative side, if the drop in treasuries, we talked about this before, the drop in treasuries is going to drive your yield maintenance penalty higher. I think treasuries are down at least 100 basis points from the beginning of this year. And so that is a consideration, is your yield maintenance penalty. I would check that with your lender. Number two is there's less buyers right now that are bidding in the market. So you might not get the highest price. And then also in terms of favorable terms, your earnest money and shorter closing time frames that you had maybe 3 to 4 months ago are gone right now. So there's going to be less buyers, so you're going to get less favorable terms as a seller. But if you are thinking about being a seller, or if you're going through that process right now, here's a couple things to keep in mind. Number one is you have to maintain your occupancy and rents at your net rental collections number as you are now, because the buyer's leverage, whether you're doing Fannie or Freddie, can be dramatically impacted. And then also you need to get ahead of renewals, right? So if whether that's 30, 60, 90 days out, be ahead of your renewals, get in front of them with pricing. If they are not renewing, then start leasing that unit. Be aggressive on those renewals. This is not the time to be pushing $100, $200 rent bumps on your renewals. Really, you need to keep that renewal base, keep the occupancy up. Number three is prepare your staff and tenants for inspections, because these are going to be, whether it's the walkthroughs, inspectors usually need to see about 10% of the units, and you need to give them notice, because you don't want to be upsetting your tenants at this point. Number four, be flexible on the timeline. There's going to be less buyers at this table bidding on your deal. And whereas you could have dictated, tight timelines, high earnest money, that's going to be different now. And then prepare your investors, right? Because this is not going to be a quick close. There's a little bit more volatility, and prepare your investors that the closing process could be, 75, 90 days instead of typical 45 to 60. And then the last question I've been getting is, should I be refinancing now? And this one I think is the most straightforward besides the other two. Rates are down 3.5% to 4% right now. The all-in interest rate's about 3.5% to 4%. So you can reduce your interest rate. You can re-amortize your loan. A lot of people who have recourse loans, 20, 25-year AM, can go to 30-year, potentially even 2 to 3 years of interest only. Number one. Number two, cash out some of the equity. Even if you do just a little bit of cash out, put that equity aside, potentially for the property, if you need it. And then you can also get off of recourse and go to non-recourse, especially if you bought a property that maybe is 80, 85% occupied. Now it's 90, 95%. Take that property to non-recourse and free up your balance sheet a little bit. And then your current valuation right now might actually be higher than it is 6 to 12 months from now, right? So cap rates are a little bit slower to move, but remember that Fannie and Freddie, they're going to take a T3 on your net rental, and that could be down. And especially if it's a downward trend, they're going to T1 that last month of collections. And so if you have a good net rental right now, you could get the highest valuation on your property. And then also if you do, let's say you have 2 to 3 years left on the term of your loan, if rents go down, you might actually be in a worse position, or the markets could be in a worse position when you go to refinance. And so if this is a property that you are going to hold on to, then it makes sense to probably reset that loan term for another 5 years at this point, 5 to 7 years at this point. Some negatives, this yield maintenance is coming in again because you still have to pay off the loan. So if you have a Fannie Mae loan on it, you still have to pay off the loan to refi. Some people are able to get supplemental loans, but if you have less than 5 years to maturity, then that yield maintenance penalty is still going to have to be paid. Closing costs are usually about 2 to 3% of the loan. The smaller the loan, the closer it is to 3. Once you get probably above $5 to $6 million, it's about 2% of the loan amount on closing costs. And then as soon as you send in your application, interest rates could go down further. But what we've seen is they've really tried to keep rates around 3.5%. So even though 10-year treasury was 1% or even dropped down to like 50 basis points on the 10-year treasury, Fannie Mae put in essentially a floor and increased spreads. And so they didn't allow rates, the all-in rates, really to go below 3.5% just on a standard 75% refinance loan. So if you're thinking about refinancing, a couple of considerations. Number one, figure out your prepay. Number two, closing costs, 2 to 3% of the loan amount. And then start preparing your T12 rent roll and also previous CapEx. So what a lender is going to ask for is, all right, what'd you buy it for? How much CapEx did you put in? And what's your all-in cost basis? And how long has it been? And then they're going to look, okay, did this person actually increase the rents? So what was your rent roll at acquisition compared to rent roll now? Most lenders don't like doing a cash out refi just based off of cap rate compression. So they want to see you've actually grown your net rental. Number three is similar to a seller. When you go through a refi, you need to maintain your occupancy, you maintain your rents. This is not the time to go in and be pushing like $100, $200 rent bumps right now. Now is the time to just sort of maintain your net rental collections and get ahead of renewals, and then prepare your staff. So a lot of these smaller properties, you may only have 1 or 2 people working on the property. So prepare them that there's going to be a lot more inspections, a lot more reports than typical for the lender, and so they're gonna be out there a lot more. So make sure they understand that, and then be flexible on your timeline. I mean, Fannie Mae and Freddie Mac have gotten a ton of refinance requests right now, and it's probably going to be closer to that 60-day time frame on a lot of refinances. And then prepare to hold the deal for 3 to 5 years if you do refinance. So if there is a prepay and closing costs, you don't want to do this if you're going to sell the deal in the next 1 or 2 years. It'd probably be better just for you to hold the deal, pay the higher interest rate, and then go sell the deal next year. And then I would like to say is, if we give you a big check back at closing for the refinance, return some of the money to investors, but also set aside some capital and put it back into the property, because over the next 3 to 5 years, there's going to be stuff that you're going to need, and you don't want your property to, get into deferred maintenance and go down a bad cycle. So next steps, subscribe to this YouTube channel, like the video. And if you have any questions, whether you're buying, selling, refinancing, set up some time to talk with me. We'll set up some time via email, or you can give me a call at 214-300-5035. All right. Thanks a lot, guys.